Hey everyone, welcome to the weekly review. Today's topic will once again be about tariffs and how Trump fucked it up big time, basically. Yesterday we got the jobs data, initial reaction was bullish, but then we got inflation expectation data, and this is what actually made everything drop. So yesterday, this week. Here on Friday. So jobs data was a mixed bag. NFP came in very low, and moving forward, NFP prints are supposed to come in lower as well. Unemployment dropped because they they increased the number of workers. So as a percentage of the total unemployment, unemployed people dropped. And what actually dropped us was this inflation expectations short term. Uh, 5-year expectation stayed the same at 3.3, but this is 1 year inflation expectation and it jumped from 3.4 to 4.3, which is pretty crazy. And this is what spooked the market. Now, I was wrong about this trade. I thought the this one, where I said that the billionaires, the oligarchs will take control and basically impose their policies. I was obviously wrong because Trump is doing whatever the fuck he wants, or not necessarily whatever the fuck he wants, but the side that is more protectionist is winning. This is not really that good, and I'll talk about this Bessett's plan and why it's infinitely better than what Trump did with the 30% on Mexico and Canada and 10% on China. Even though he backtracked for now, but I expect those things will happen at some point, and uh, uh, and it's unavoidable at this point. And what you should be considering is this is not a temporary measure, or it's a temporary long-term measure. For tariffs to work, you need a lot of time, meaning they have to be in place for, I don't know, 10 years or something, because they have to change behavior. It's not necessarily about the money they bring in or anything else. Like to get, let's say you want to reshore. Yeah, you want to bring manufacturing back to the US. It's not like you implement tariffs for 6 months and instantly people will come to America and invest and build factories. It takes more time than that to be actually build a factory. So it's not like the tariffs will come in, something changes or breaks in 6 months, and then they back down. No, that's not gonna happen. For tariffs to work, they have to change behavior both in the population, in the business class, and in trading partners. And for tariffs to actually work, they have to be there for 5 to 10 years at a minimum. Like 5 years is the bare minimum for that to happen, because the population has to re-educate themselves into buying something made domestically. Um, there has to be a business reason to build a factory in the US if you don't already have one. So that won't happen overnight. So tariffs, when they come, they will be here to stay, and most likely for the whole Trump mandate, but possibly in the future as well. Just like Biden kept the tariffs on China, I don't think a democratic uh, government would remove most of this. Maybe they remove some of them on close allies, but not all of them for sure. So why is this a much better plan than what Trump did? Well, first of all, it's not nominal. Uh, while the inflation expectations for the short term spiked because the tariffs are huge. 30% on anything is a huge amount. Obviously, it will cause inflation. But the genius of this, it's only 2%, 2.5% per month. And most likely this would not have gone every up by the same amount every month. Maybe it was something like 2.5% initially, and then it went up 1% per month. And in 1 year, it would have been like 15%, which is a much leaner curve, and it would have not it would have caused inflation not to spike, or the spike would have been over time, not something that is a shock. So this is much better because it's not a shock. Secondly, it doesn't discriminate. Like I said, it's not nominal. It's one thing to say we're imposing X% on Canada. The Canadians take it personally. They revolt. They feel they're under attack from an ally actually, and this is a bit unpleasant to be the target of something like this. But if you do it globally, nobody takes it personally because everyone gets the same treatment. There is no discrimination. There is nothing really specific to take offense upon. And on top of this, if it's for everyone, it it immediately brings in more money to the budget because everything that comes into the country gets tariffed. So this would have been a much 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 better plan than what Trump did. Even if what he initially announced, the 30%, is not the thing that becomes reality eventually. And because the way he did it threatens inflation, and it's not in a final form, uh, it's like a sword hanging over the market's head. And for the foreseeable future, I think it's impossible for the market to go higher unless we get a, a conclusion on this whole saga. And even then, it's arguably like he can change his mind. Arguably, it's not the final outcome for this. Like even if he signs the deal, because the trade deals he has with Canada and Mexico, he signed those deals in his first mandate. So now he's saying they're bad deals. What's to stop him from doing the same thing 6 months from now on whatever is decided right now? So it's a highly volatile situation, and it's unclear how it's going to play out. But let's assume that things reach a final form, maybe then the market can go up. But it depends what the final form is, meaning does the market think it will bring inflation? And the problem with if the market thinks it will bring inflation is that the Fed cannot cut. Whatever the market thinks is basically what the Fed will think. If the Fed fears inflation coming back, they will not cut. And if they do not cut, that puts us in Chem's first scenario, in which the Fed is not accommodative and the market needs to correct at least 10%. And right now, I think we are in that scenario, and very likely we have started a new impulsive leg down. Next week, I expect to see breakdowns, especially because Trump said he's gonna announce some tariff bullshit as well. Yeah, I know the one with the uh, too long a feed. I won't look at it. The one with the reciprocal tariffs or something, which means that if another country has tariffs on the US, he will impose the same amount of tariff to that country. I honestly don't know who has tariffs against the US. We'll find out next week and see what the impact is. He also threatened tariffs on Japan. And yeah, so I don't think the market would like this behavior, and we should see continuation down next week. And because the fear of inflation is very high, as we have seen, we should be getting a breakdown relatively soon. If there is, I don't know, talk of appeasement, maybe the market stops again at the election gap. But if not, we should be seeing a breakdown relatively soon. Because we're in that scenario in which it's impossible for the Fed to cut if we get 25% tariffs. Or anything, like I said, anything above 15% in the in the Blue Sky post. Anything above 15% is very bad for business. If we get the soft version that Bassett proposed, or it was leaked that Bassett would propose, that's that would ease inflation expectations and would allow the Fed to cut, and the market can go higher and break out from this range. But if we don't get that, tariffs are coming. They will be big. They will be here to stay for a long while because they have to change behavior both in population and the business class, and we have to live with it. Now, this being said, everything from a technical perspective is pointing towards this as well. Uh, let's take it one by one from the breadth stuff. Another engulfing candle. Every Friday we get a rejection, continuation on Monday. We'll see if we get continuation on Monday as well, but I assume so. Uh, Depending on what happens over the weekend with Trump as well. So yeah, first of all, this breadth indicator starting to go down. Breadth has been dropping, as you see here, since we topped out in January. This is McLaren oscillator. We have been going down and we closed negatively. This again going down. This is basically a two moving averages of stocks above the 20 MA. And MACD topped out much lower than previously as momentum and is trying to curl down and cross over into negative territory as well. So that's kind of it for the major indicators, and they're pointing towards a negative crossover. The news is unlikely to be positive, and when we look at this, this is what I had drawn for Friday. We didn't go up, and still think this is kind of how it's going to play out. Could get a short bounce here. Do this. So something like this. Some consolidation here that could take a couple of days, but eventually we should break down towards the yearly open. Obviously could happen directly as well. Oops. This. So yearly open, uh, we've been going above and below it for a while now. Uh, Bias was bullish while above, bearish while below. If we go below it again, obviously it's not a good sign. And like I said, I think we see at a minimum this area retested with a very high chance of breaking down. I do think it's gonna be a bit more like this. We have to test it. Maybe we don't go this low. Maybe something like here. But we have to test it from below. Like every time we went below it, we almost immediately went back above. And we never got rejected from it on the way up. For us to actually, if we see a rejection while trying to go up, that is a very bad sign, and very likely we will get rejection, a breakdown after it. So we went below, went back above, went uh, went below, went back above, below, went back above almost immediately. So we haven't really seen rejection. Maybe let's say a bit here, and you see what happened when we got rejected. Like we went below, tried to get above and fail a couple of times, and then we get another leg down. This is what I mean. But what I would like to see is basically this, but a rejection here, a strong rejection here. Had we seen this, most likely we would have broken out here. So this is what I will be looking at uh, for next week, or not necessarily next week, but for the next couple of weeks, to go back below the yearly open, have a bounce, have an attempt to go to take the yearly open and get rejected. Once the market participants decide that no, this is a line we won't get above again, it's a very bearish sign. And again, this is week of distribution. We need an LPSY in which we make a lower high here. Oops. Oops. So this is a low. We need something like this. We kind of did this. It's too large. Let's find a smaller one. This one. like this. We have an UTAD here. We have lower highs. We just need to go down, bounce and get rejected and make like a lower, like this LPSY here or something like this. So this is how it's playing out. Again, uh, based on chance prediction, we are not going to get an easing Fed because the threat of inflation is too high because tariffs are too high. If we do not get an easing Fed, the market will eventually break down and give us a minimum of 10% pullback before maybe maybe Trump backs down. We will see, but we need some type of de-escalation before we can get back up, and 10% is 540 here. Here, this is 10%, 20% is 470, a bit more than 20, but it's the previous all-time high, so it's very likely to play out as support. Yeah, that's kind of it for today. We don't really have anything new to play with. A bit more clarity on the fact that inflation is a not a threat per se, I would say, but uh, the market thinks is the biggest risk. I disagree. I think once the tariff talks are going to be coming in, is gonna shift again towards we have yield spike, but again we have the 2 year going higher than the 20 year, and whatever you may think, basically this is the Fed fund rate. We shouldn't have the 2 year go above this level because we are like even if the inflation comes back, we are still significantly restrictive from a Fed funds perspective. We are way above that. And what we should be seeing is another reinversion, meaning the 2 year goes higher, but the long end of the curve goes down. Or if it goes up less than the 2 year goes up, because it means short-term inflation fears, but long-term growth fears, and they are both right. But given that the system is super leveraged and there's still a lot of euphoria when we speak about growth expectations and earnings increase expectations. A mean reversion, once it gets started, is very difficult to stop. So we have a risk of a cascading sell-off that goes way more than people expect. Like we don't get 10%, we get 20%, or we don't get 20%, we get 30%. And once that that snowball gets rolling downhill, it will keep growing very fast because the leverage in the system will get liquidations happening very quickly. And if that happens, all the inflation fears go away because people will fear a recession more than inflation. So yeah, that's kind of my take. We'll see how it plays out. Have a good one. Bye bye.